Welcome, everybody. Welcome, Lynn. Hey, Charles. Hope you're well. Hello, Patrick. I see we've got Eric with us today. Hello, Michael, Eros, Joseph. Thanks, everybody, for joining us today. And yeah, today what we'll be discussing is of course, UK property investment market, represented by Fabric Property Group. Just as a very brief introduction, my name is Dale Anderson. I'm one of the directors here. I'm actually based in Cape Town, moved here a few years ago, but I do spend some time. I lived in the UK for 16 years. So I help clients from South Africa, Turkey, Middle East with UK property investments. To date, we've raised over 1.5 billion pounds. We collected between me and Matt, we've got both almost 2 decades of experience. We've invested ourselves before. So today's quite exciting. We're looking at sort of different growth regions. Of course, Manchester city centre has rocketed in price. I'm seeing things at £600 plus per square foot. London's, of course, very expensive as well. But if you actually look at the data, some of the best opportunities are commuter belt towns and cities. So without further ado, Matt, would you like to make a quick introduction?
Yeah, thanks, Dal. Yeah, great to be here and good to see everybody who's joined. Yeah, just like Dal said, one of the directors here at Fabric. I'm based here in the UK side out of our London office, helping our clients build their UK portfolios. Interesting what Dal said. We've seen an interesting shift in the market given prices inside city centres growing so strongly in recent years. I think Madal mentioned there about £600 per square foot in Manchester, which, thinking back 5 years ago, you'd probably have a laugh at that number. But here we are today. So, in today's webinar, we're going to be talking about how to benefit from those city centres, but maybe for some commuter belt areas to get that optimized return.
That's it. Thanks, Matt. And I'll share the screen in a minute. But yeah, just wanted to say that having lived in the UK for some time, most people, like in London, for example, they don't really live in central London, right? Unless you're like super rich. And also, we commute. So we'll live in places like Sevenoaks, Kent, Essex, where Matt's based. I bought property in the south of London, and that's where I did really well. I had some very good growth. And I sold some of those properties. They went up in value, and I bought a property for say 200,000, sold it 6 years later for £300,000. But it had train access into the city centre. That's where most of your families are living. So I'll share the screen with you quickly. So back to the presentation. So on today's agenda, we'll talk about the changing investment landscape, a shift in the market, what this means for investors. So yeah, let's just get straight into it. Hopefully, it'll provide value. At the end of this webinar, we will also be providing a free guide and a free strategy session. If you stay till the end, you can also ask us some questions and answers, and we'll have some special incentives and offers available for our partners, investors, as well as our agents that we work with. So, the changing investment landscape, what's been happening in the markets? Of course, there has been quite a bit on the go, especially when you watch the news, the dreaded news. You never know kind of what's going on and where's the next place to invest. One positive thing with regards to what's happening is since COVID, inflation stabilized. I think it's sitting around 3% now, Matt, if I'm correct, roughly
Yeah,
around there.
3.8%. You literally just released
3.8.
the day or two ago.
Yeah. So what that means from a economic perspective is interest rates have stabilized and started to come down. So we've now started to see investors, even international investors, we've got some special mortgage products available now at 5.99%. So from my experience, you need to look at the market now. We're on a bit more of a buyer-friendly market, and I guess that's partly due to the current government of Labour and their policies. However, it is a time where you're in a buyer-friendly market, you can sometimes secure better opportunities. You're on the ground, Matt. You go around the cities, you have a look around. Can you give us an update on what's happening for the overseas audience? And yeah, just give us a little bit of your thoughts on it.
Yeah, absolutely. Yeah, I mean, like you was just chatting there about the interest rates. The last sort of 5 years since COVID, we've definitely seen less bullish investor sentiment from leveraging, in terms of using finance to purchase because the higher interest rates made it less attractive to utilize. So you saw less loan to value if finance was used, or more cash purchases happening. However,
Mm,
like you mentioned about, inflation stabilizing and interest rates coming down, we do see ourselves moving more into a buyer friendly market, like you say, with leveraging becoming more attractive to help with
mm.
the financing of purchases.
Brilliant. And one myth buster, let's call it, is we can get mortgages for overseas buyers, so you don't need cash. We do work with partners such as International Property Finance Group, as well as DNA Finance, who do specialist lending for clients from South Africa, Turkey, and they base it pretty much on the same as they would in the UK, on your income, affordability, and the actual property that you're buying. So that's just one thing to notice. So definitely look, I think there's been more change in the past 2 years than we've had in the past decades. Interest rates went up because of COVID. Some people then were overexposed, right? Because now their rents all of a sudden not as cash flow positive. And that's the trap you want to try and avoid when those interest rates do go up. But right now, we are seeing a market of cooling interest rates. So it's about lower leverage, stronger yields, and flexibility. Onto the next slide, shift in the markets. Again, we are seeing more hybrid workers. So where it was a case back in my day, I sound like a veteran now. I had no choice but to be in the office from 8:30 or 9 until 6 every day, and I did that for a good solid 15 years. Whereas now, since COVID, that's kind of changed. We're finding a hybrid remote model where some people are in the office, the operations team, the aftercare, the purchase progression marketing, but then we've got some salespeople dotted around in different countries and different territories. So we are able to hybrid work. And that's also shifted the market in terms of where people are deciding to actually live. Because you can imagine a young family, especially with the cost of living in the UK, would rather save some money if they can work in a place where it's still, 2 days a week you can get into the office. I mean, what are your thoughts on that, Matt? Have you seen any shifts?
Yeah, good question. I think we're seeing more people coming back to the office,
Okay.
environment. It was obviously since COVID quite a prevalent work from home model was very, very popular. But
Mm.
we do a lot of transactions in the commercial space as well as the residential, and we're seeing workforce really returning to the office.
Mm. I saw a report that commercial property is bouncing back as well. So that seems to be a sign that perhaps people are getting a bit tired of working from home as much, but they do sometimes want that bit of flexibility, right? So if it is a case, office 3 days. So what that means, we've seen a shift of people moving into more urban areas like Reading, even Luton, and these kind of towns where they can easily get into London, into the office, but without the expense of having to live in the centre of London. So, yeah, Savills have said commuter towns are outperforming London since 2020, I believe. And again, that sort of gives you an idea of which areas are more affordable, new growth zones are emerging, and then there's yield stronger beyond the city core. Yields compared to, I know you done quite a bit, Matt, with Berkeley Homes and some developers in central London. What's the difference between, say, the prices in, for example, our new project St Albans versus a new apartment in Battersea?
Yeah, no, really good question because they do differ quite considerably. So we recently did a transaction for one of our clients based over in Turkey, actually, and the purchase was bought for my client's daughter to come and study here in the UK in Battersea, like Dale mentioned. They bought a two-bedroom apartment for just shy of 1.4 million. You then look at somewhere like St Albans, which we'll go on to in a bit more detail shortly, still only 18 minutes direct into central London, and you can get prices in between sort of 250 to about 450. So
Mm.
dramatic difference, but still very good access into central London.
Great. We'll go into more detail on that, but it's all about affordability. Most professionals, especially young professionals, they don't actually live in the city centre of London. They'll travel in from Kent, Sevenoaks, Wimbledon, Croydon, places like that. Some areas are obviously nicer than others, so that's something that one needs to consider. But you do also get better yield because the prices are lower, the rental yields are actually higher and been going up in value quite a bit in recent times. And I mean, let's face it, London's always going to be whatever people say, it's always going to be a global brand, right? It's always like a major financial hub, in my opinion, Matt. A lot of people are like, okay, moving to Dubai, that's great, but one needs to consider 2009, I was in this industry. And, I'm not tarnishing Dubai. It's a great market and I love the place. It's very ambitious. But I posted recently saying London is still, you've got 7, 8 million plus people, Greater London. So there's always going to be demand that's outstripping the supply, in my opinion. So, one needs to look at London Central versus commuter belt, depending on their budget. I get clients asking for Central London, £200,000, and it's like, unfortunately, it's just not realistic unless we're selling something that's not of good value. So it's accessibility and affordability. So we're going to London commuter belt. As I mentioned, I believe London, it still heads up some of the biggest bank systems. You've got Westminster, you've got a huge amount of tech companies still based in central London. So it still plays a very important and pivotal role, especially on the economic stage in the West. Matt, what are you hearing from investors sort of making that shift? Are they moving focus away from London, or what's the general appetite on the ground?
Yeah, absolutely. And it's another good question. Most people we speak to are looking further afield from London. They love
Mm,
the capital, the economy strength of London, like you mentioned it,
mm,
financial hub. But in terms of investment returns, it can be a difficult one because
yeah.
prices are very high, yields are relatively low. So
Mm,
to make it make sense for an investor, they're looking further afield, which is where the commuter belt aspect comes in. They either look to the commuter belt regions of London or they'll look to the northern regions, which I know we're going to touch on later in the
mm,
web. So yeah, I think it's the key thing that they're looking for is a mix of yield and capital growth. Most people we speak to, and the commuter
mm.
belt areas really do serve that, especially with good links into London.
That's it. So commuter belt London is basically your towns and areas and nicer suburbs of good green space, good schools where you can still get to work in the city centre at the office, basically. And that's what's driving the demand. So places like Reading, Slough, Maidstone, those seem to be outperforming London in both rental growth and capital appreciation. I know Savills projects up to 19% growth by 2030 in those outer zones compared to London's 13% growth in the same period. So again, Reading, Luton, Slough, Maidstone, key areas to consider. But besides that, there are other areas. There's Ashford, which is near the tunnel, the Euro tunnel. And then you've also got places like St. Albans, which are historic locations, Canterbury. So when we talk commuter belt, you've got your inner commuter belt, which is like maybe zone three, zone four, let's call it, on the tube. You've then got your middle belt, which is now we're talking more like St. Albans, perhaps Croydon, perhaps, those closer cities and towns. Wimbledon is a good example. And then you've got your outer belt, which is then Cambridge, Oxford, and those kind of areas. So, is there any other locations right now, Matt, where we're seeing strong demand around London, or any thoughts
Yeah,
on that?
I mean there is good areas. I think some of the ones we've got on the screen are very popular. St Albans is another interesting one. It's got that historic,
Mm,
features to it in the fact that you're going to have really quintessential English heritage on your doorstep, but you're very quickly into central London. So yeah, I think one thing I would always say is there is lots of good areas, but choose a few focus on them, and then
Mm.
make that decision, because it can be easy
Mm.
to get paralysis by analysis sometimes, and
That's
know,
a good saying.
you can consider
Yeah.
everything, and
Yeah.
then end up not doing something. So I think
Mm.
the biggest thing is find somewhere that has good fundamentals for investment, find a good project, and then take action. And that's the advice.
Agreed. Yeah, so we kind of that's part of what Fabric does. So we do a lot of due diligence. I was speaking to Daniel, who's now helping me on the product due diligence department. Pretty much we will get offered everything and anything on the market. They'll come to us and say, can you promote this or help us sell it? We then go through a 100-point checklist. We do the due diligence. We do AI-driven data on it as well now, and then we also check it with the Savills, JLL, and Knight Frank reports, just to make sure that we're focusing on the right areas. So, say we get offered in 1 year, maybe we get offered 50 or 60 developments. We do need to narrow that down to a few key projects. So maybe two or three in London, two or three commuter belt, two or three in Manchester. So we'll pick which we feel are the best, but also provide the most safe and reliable income for the investors. So here's a yield comparison chart. As you can see, London 3.5% compared to Reading at 5.2%. Similar yields in other commuter town areas, and where you can do service departments, you can actually get higher rents on Airbnb, for example, sometimes between 10% net yield, about 12%, 13% gross. So this is the latest development. I really like this project. It reminds me of when I bought my apartment in Sanderstead back in the day. It was a nice conversion, brick built. So Forum House is £250,000. It's a small boutique development. Am I correct? It's around 60 apartments, Matt, 60, 70 units?
Yeah, 63 apartments it is. Yep.
Okay, cool. And then St. Albans as a town. Tell us a bit more about St. Albans, Matt. I've been there almost like a tourist once just to go check out the cathedral and things. It's got a lot of history. Do you want to
Yep.
maybe just explain a bit more about it?
Yeah, so it's a cathedral city. It's had 71% price growth over the last decade, according to the Office of National Statistics. So it's traditionally a affluent area. And one of the reasons why this area can sometimes be a little bit overlooked is that people might not think it may have that yield aspect to it. It certainly has got the capital growth. Like I say, it's an affluent area. So people that live in those areas tend to be well-paid professionals, which means the affordability is there. And when you've got the affordability, that means you've got the price growth on your side, and of course there's competition for those properties that are there. So St Albans is a really good pick. It's 18 minutes into London, St Pancras, so central London. So it's a really well connected position just to the north of London. If you looked at it on the map, I'm not sure if we've got a map in this web in these slides, Dal, but that is just north if you sort of picture it on the map. But
Yeah,
it does offer a great option for yield, because you can. I think this particular property, it says that on there on the screen, has short-term lets permitted. St Albans is a great area of the country for visitors as well as permanent residents. So you've got that angle there that you can really optimize your yield as well as have capital growth. So that's
great.
hopefully gives you a bit more background.
Yeah, and then of course you've got the service department route there. There's a lot of regeneration. We've actually got a full presentation on this project, so I mean that's quite detailed. It goes into the all the data. So if you do want to consider that further, just drop in the comments Forum House, and then me and Matt will be in touch. We can show you where it is on the map and do a virtual meeting. So just drop in Forum House, and we'll be in touch. So on to Greater Manchester. I mean, Manchester's it's one of those markets. Honestly thought maybe there was a bit of a bubble because of the amounts of development going on, but it seems like the city council just got it right, and there's just more and more investment happening. Um, in terms of Manchester, what are you seeing the latest trends
Hmm.
in the city centre, Matt? And is there still appetite for city centre, or what's the general uh, view of Manchester at present?
Yep. Well, Manchester, I'd have to say, has been probably one of our most popular locations in the UK for investment with our clients. It provides really good entry price point and a good sort of balance with yield as well. So, it's been a very good growth story of Manchester with all the investment that's gone in with Noma, which is more centrally located, and Spinningfields development in the city centre. That's been a large contributor to getting to those heights of the 500 £600 per square foot we mentioned earlier in the webinar. But some real key themes, there's lots of regeneration projects that have happened over the last decade in Manchester. A couple I've just mentioned. A real key one has been Salford Quays Media City, which
Yeah.
we've all probably seen if you watch the BBC News. The BBC moved part of their operation up to Media City in Manchester. Huge regeneration development headed by Peel Group, which has been a huge success. And
Mm.
they're doing a new one, which is in the Commuter Belt region called Trafford City, which is following on from Media City, which I
Yeah.
think is the new trend in Manchester, which is going to have that growth similar to the Media City.
That's it. So kind of that investment is now going slightly outwards into Salford. We've seen it in Media City, and now we're starting to see it towards Trafford. They're building the Trafford thermal spot center, and they're building like. Tell us a bit more about what's going on in Trafford at the moment,
Yeah,
specifically
absolutely.
near
There's
the football
4.2.
stadium
Yeah, there's obviously you've
for
got
the
I think
Manchester
well
fans.
documented. Yeah, you've got the Old Trafford, obviously extension redevelopment, if you like, probably well needed. But the key thing, there's 4.2 billion pounds worth of regeneration happening at Trafford City. When you have
Mm.
that volume of investment going into an area, that's going to have a ripple effect on the properties directly local to that investment. And like Dal just mentioned, one of the key headline projects of that regeneration project is Therm Wellbeing Spa, which is
Yeah.
and resort, which is an indoor well-being attraction. They've also got the Sea Life, Sea World, sorry, which is at the Trafford Centre. You've also got
Mm.
Old Trafford, of course, Manchester United, and also the indoor ski centre is directly next to Trafford City as well. So lots going on, which is going to
Mm.
increase jobs. It's also going to
Mm.
increase the prices of the properties locally.
Great. So again, very quick commuter belt into Manchester city centre, but 30–40% better value, right? And
Yes.
then you've got all this other investments, full stadium there happening. So yeah, we
Just to
kind of
give you an
follow where the
example,
regeneration is, I guess. That's the, but yeah, go on, Matt. You were going to
yeah, no,
say?
just to give you an example, literally just to off the cuff, just to say, we're talking about city centre being 500, £600 per square foot. Just to touch on
Mm.
your comments there, Dow, about, much, much better value for money. Trafford, very close by to the city centre in the Trafford
Mm.
City regeneration area, you can pick up the property between £300 to £350 per square foot. So you're
Mm.
talking almost half price compared to the city centre. So
Wow.
it's going to
Yeah.
have a natural effect on your yield, and the
Mm.
rental you're going to attract isn't going to be in the same proportion. So your yield will be higher in that
Mm.
slight further out location. So um,
That's it.
really
Yeah.
attractive position.
Great. So, I mean, we've got property in the M1 post corridor if you want. We've got some fantastic units, completed Potato Wharf, but the prices are there. Two beds, what, like 370 around there, Matt.
Yep.
But great location. So we definitely have city centre stock, but One Trafford Edge in particular, it's what stood out to us was the great price per square foot. It is because it's a conversion as well, but it will be regenerated to a nice standard. But Manchester's boomed compared to all the other cities. We've really seen it's been the best performing region over the past 5 years, and it seems to consistently keep growing. So, it seems to be quite a special city. I don't know if the council got it right or whatever, but a lot of investments. They call it the Northern Powerhouse. So it's really done well. Plus, you've got the students, right? There's like uh,
Absolutely.
almost 100,000 students in the
Mhm.
city
Yep.
who often retain or stay in the city and continue to work. So yeah, as mentioned, we've got a brand new project, One Trafford Edge. Prices start from only £190,000. Your rent start from around £1,150. So you're looking at a 6% net yield. Do you want to maybe just run through that new project, Matt? I know you've recently had some clients purchase there.
Yep.
I've not actually been to the site as yet. So do you want to maybe just give us a bit of an overview?
Yeah, sure. Yeah. So this option is something that is a really good proposition for somebody who's maybe not has the affordability for the city centre and is looking to sort of benefit for some growth over the build phase of a project. So One Trafford Edge, it's a new build conversion. So the building already exists. They're going to be stripping it back to its core and then rebuilding it. Comes with a brand new build warranty. It's pretty much directly over the road from the Trafford Centre and where all that £4.2 billion investment's going in. But it's somebody who's got an appetite for the longer term, for the growth, in terms of this one completes in 2027.
Yeah.
So you only need to put down 20% now at exchange, and then the balance can be on completion, can be either cash purchase or it can be mortgaged if you want to. So superb option. It's been extremely popular. We only launched it, I think it was a week or two ago, and we've had
Mm.
a lot of reservations in this property just
Yeah.
because of the more affordable nature. We're not saying by any means in this webinar that we're detracting from city centres. Of course, location is a
No.
key factor, but this is also an alternative great option if you want to
Mm.
get in on the city centre action, but just at a slightly cheaper price.
Yeah, we've got access to the whole of market, provided that the projects are funded and it's passed our due diligence. We do have access to, M1 postcode luxury developments as well, which are also good value for money. But of course, today's topic is commuter belt. Can we do short-term lets on this, Matt? And
Can Yep.
what's our cash flow looking like?
Yep. So residential property, you're looking at about 6% net. And on short-term lets, you're looking at about 8% net after your deductions. There's some really nice
Mm,
amenities at this project as well, in-house, exclusive for residents. So they've got a internal gym, resident-only access. They've got plunge pools and infrared sauna, and they've also got co-working spaces as well. So some nice amenities there. We've noticed, there's been a flight to quality over recent years for tenants. They
mm.
don't, they want to live in quality spaces, and this one certainly ticks that box.
Brilliant. Same as like Forum House, there's like I noticed they've got like a games room, they've got co-working spaces and things like that. So
Yeah,
it's those little things that aren't gonna like boost the service charge too much, but just, add a bit of communal space and community living, I guess, is the
absolutely.
approach. Yeah. Great. So there's a new one there. The next location we believe is definitely worth considering is your Birmingham's outer ring areas. So your Jewelry Quarter. We've got a fantastic new development there called Fountain Court. And Daniel, I know one of our team that's working on product went there, sent me some videos. It's a great building, but he actually said it's like right near it's an excellent location near the main businesses and things like that. But again, you can get better value for money if you start to look at places like Solihull. For example, we had a development there called City Green. Clients were picking up one beds, if I recall, about 170, 180. And it's actually the first stop on the new HS2 just before you get into Birmingham, right? So what are your thoughts on Birmingham as a market, Matt? It's quite often overlooked, I think, considering the high-speed rail is currently under construction, and it's going to cut the commute down quite heavily into Birmingham.
Yep, I really like Birmingham, I have to say. Birmingham, Manchester, Liverpool, obviously the key northern cities. Of course, there are
Mm.
other good cities as well, but they're the leaders. HS2 is going to make a huge difference to that.
Yeah.
We follow where the big names are. Barclay Group, probably one of the leading developers in the UK. The
Mm.
only location outside of London that they are developing in city centre is Birmingham. So
Mm.
that tells you, follow the money, because that will give you a good indication of where the market's going. So,
Mm.
yeah, I really like Birmingham. I think there can be really good value. I think the city centre is still good value given that HS2 will be delivered, and that will mean, train travel into London can be as quick as just around an hour into London, which is still hard to compute when you think about it, the distance that is. But
Yeah.
it's going to really, I think, increase prices as that comes to completion.
Yeah, a lot of big companies moving in there as well, I believe. So there has been quite a, KPMG and things like that setting up offices there.
Yeah,
And then you've got Curzon Street, Digbeth, and Smithfield Regeneration, which is transforming that particular region.
yeah,
So yeah, millions of pounds being invested into the city. Probably as spotlight's been more in Manchester, but I think with the Crossrail actually now happening and underway particularly around that Curzon Street station, that's going to be the major new station, which isn't like right in the city centre, but anything around there, around that HS2 infrastructure, certainly for me, is very appealing. Crossrail and ongoing rail improvements continue to also boost, ra rail across and speed up the time to London. So I do think that's a good market. We do have a couple of options, both in the more in the city centre and then also some more lower entry options, which are quite close, not far, but you think you're talking sort of 10, 15 minutes from the actual city centre. This has Fountain Courts, which mentioned near Snow Hill, 6% plus yield. It's got a really cool story, this one. I believe it was like an old courthouse, courtroom. Do you want to maybe run through a bit of that, Matt, and the actual building itself?
yeah. Historic building. That's one of the key benefits of these cities. They've got very good historic heritage there. So
Mm,
that the council has done a good job of maintaining that look and feel of the city. So this is a repurposed building, like Dow said, mixture of
mm,
one beds and two beds, and it's the location of that one is incredible. It's there's a site in Birmingham called Paradise, which is like an office sort of district, if you like, which is the number one working area of Birmingham. And it's very
mm.
close to the Snow Hill train station. And also not too far away is the Curzon Street HS2 terminal. So again,
Yeah,
that property there isn't as much about yield because you can't do short-term lets there. So it's residential only. That
yeah.
particular one is much more about capital growth. We see that one, and that's why it's on our books, is that somebody who's more interested in capital growth,
Mm.
Fountain Court would be a great option for them.
Yeah, that's it. So we've got a selection of studio one and two beds, and the building itself looks great, but also this particular developer or a award-winning developer, Elevate Property Group, and the quality of their finish, as you can see in the images here, very, very good high quality specification. So very well established developer. Again, the project's funded. There's 88,000 students. You've got a 49% graduation retention, and then you've got over 7,500 London professionals relocating annually to Birmingham, just to bring up some of the data there. Plus, this one comes with a 10-year RCW, which most of our developments do, new build warranty. And this one will be completing in Q2 2026. So, again, if you want information on that, just drop in the chat and we will send the details. Just put in there Birmingham, and we'll get the email sent across. So the next slide, again, just comparisons in net yields. So some cities like Solihull, Dudley, Walsall, that's your very net position based on the Office of National Statistics. But if you look at some of the new build developments or some of the stuff that we are getting, you are looking more along the lines of 5, 6% net in those commuter belt areas. Some comparative analysis, again, just to give you some data here. There's the difference in growth between Solihull, which I mentioned earlier, which will sit just outside of Birmingham, and then you've got Trafford, 5.6% yield, 21% average growth, and then Reading at 350K average price and 5.1% net yield. So just to give you an overview on some of those other areas. In terms of Fabric Invest, we do look at the top growth areas. We believe 2025 to 2030, and many other professionals are saying the same. Places like Manchester, Birmingham, and St. Albans, we believe will outperform other areas. And with rates stabilizing, of course, that's helping. Interest rates are coming down. So whilst there's no kind of like deferred payment plans like you get in Dubai, you usually only have to put like 10-20% deposit, and then you only have to pay the balance at completion. And we can leverage up to 60-70%. Most cases, I'd say 80 to 90%, they're cash positive. So, you're getting your tenants paying your rent, right? Good debt, bad debt, they always say. Use the bank's money if you can. But of course, it depends at what stage of your journey you are. So we'd always advise having an investment strategy session with us first. We really want to find out, why are you buying the property? What's the plans? Is it for retirement income? And then we can map out a tailored strategy for you. So investor strategy insights, again, match yields and growth goals, focus on the market fundamentals. What are some of those market fundamentals, Matt, when you look at property investments? What are the key things that you look out for?
Yep. The number one thing is demand. Always buy to demand, a growing demand at that as well. You don't want to buy a nice property and then not be able to let it. So I know it sounds quite basic, but that is really the premise of property. You want to buy in an area where you've got a captive audience that is growing, and that if a tenant was to vacate, you could let it pretty quickly. So we look for key things like population growth. Some things that drive that is the universities, of course, transport links going in. Birmingham is a great example we touched on today.
Mm,
Also, the creation of jobs, generally things like regeneration projects, stimulate those areas of the market. If those things are happening in a market, that's stimulating growth and means that we can benefit from buying into an area and riding that growth of, so they've got the capital growth, but also the rental growth as well. So those are the
mm,
things that we look for. And also, of course, again, against demand, you've obviously got supply. If there's an undersupply in an over demand
mm.
area, that is, the perfect storm for a good investment.
Yeah, that's it. So most of these cities, what we're seeing is a undersupply and a high demand. So, for example, unit will come on the market and you'll get 5, 10 in supply in the first week to rent it out. When it comes to selling these apartments, again, these are areas where there's such a high demand from first-time buyers in particular that the properties sell quite quickly. So we look at the data, we look at the fundamentals, and we look at where demand outstrips supply, which I guess is the basic fundamentals for investments, right? Whether it's Bitcoin or gold, it's all about supply and demand, which drives gold. But real estate, what I like about real estate, it's underpinned by an actual asset that you own, and you can structure it in a way that can be efficient or tax efficient in the future. Obviously, we're not qualified to give tax advice. However, we do work with tax specialists who can give you advice on whether buying like in a personal name or limited company makes sense. Other things to watch out for, which we've noticed in the last 2 years, there's a big one, service charge. So, Matt, how do we control this service charge issue where, say, the block managers, all of a sudden service charges have gone up? Now, there has been inflation. We all know there's been inflation because you can look at the price of food, gas, everything else.
Yeah.
The reality of it is there has been inflation on service charges, but what measures can we take to mitigate, high service charges which may eat into the return?
Yeah, I think first of all, you want to do a stress test. Obviously, have a put the financials together with the presented service charge, but then also run another scenario with a higher service charge just to see what impact that would make, and be prudent in that, so that we always say, look, there's going to be a settlement period for service charge. So what it would be day one may not always be what it is as it moves forward, and it will
Mm,
settle out. So that's one thing I would suggest, is to stress test for sure. Second thing
mm,
is to request and look into the block manager's previous service charge budgets. If it's an off-plan property, request
mm,
a reference from a different property that they manage to see year on year, have they managed to keep it quite stable?
mm,
Because service charge budgets can really fall on how good that block manager is at
Mm.
budgeting and managing the
That's it.
building.
Yeah.
Because if they haven't got eyes on the books and the pennies, that
Mm.
can mount up, like Dale's saying. It is an important thing to consider. So the
Mm.
key thing is stress test initially, and then second of all, make sure you've got a good block manager who knows what they're doing and will
Yeah.
look after that budget.
Once again, I mean, it's nice to have a flashy property with a rooftop pool or an indoor cinema and a gym, but one needs to consider the more facilities, right? That could
Yeah,
put some people like, yeah. So one
you
needs
touched
to,
upon something
you got
earlier.
to find a balance. Yeah.
Touch upon something earlier, Dal, in the fact that the developer at the Manchester property we shared today has found a real nice balance between giving some real nice amenities, but not
Mm.
having really high upkeep costs. So, rather than having a full, fancy swimming pool, they've got some
Mm.
plunge pools and an infrared sauna. Now, that's a great USP for a tenant to come in. However, it's not going to cost the world to maintain that. So, it's getting that balance, and that's what we do. We work hard here at Fabric to ensure that we're getting the right projects that aren't going to
Mm.
be costly service charge, but are also going to be really attractive to tenants, so that you've got a very
Yeah.
good and stable investment.
That's it. Along my journey, my first thing that I learned is to make sure these projects are funded and good developers and they're going to get built. So, of course, we've solved that solution. But then there's other things, the aftercare, the block management, there's a whole ecosystem around that. We've got a fantastic team in the UK who are all experts in their field, chartered surveyors, property managers. So we'll make sure whoever we put you in touch with to rent the units out are going to do a good job, but also offer good value for money. Another thing to consider is mortgage rate shifts. Like if you know rates are going to something is going to happen and rates are going to double, what do you do to manage or mitigate that? Because there's a lot of agents out there, they're selling like, oh yeah, we can get 4% interest or 3%. You're going to make a great return. But the reality is, again, this needs a bit of stress testing. I mean, what's your thoughts on the mortgage market at the moment?
Yeah, good question, Dal. So the like we said earlier, the sentiment in the market is that rates are coming down. Inflation, I think, stayed steady for I think for the first time in a long time at 3.8. It was expected to peak at 4. It's actually lower than that, which is a good thing. It's peaking lower, which
Mm.
then lends itself that interest rates will also start to come down as well. So that's a good thing. But I think, in terms of this question you're asking, I think stress testing is a must. Making sure that you put into your calculations what happens if it goes to a higher percentage, because we all don't have a crystal ball. So making sure
Yeah.
you're okay if there is a flex in the interest rate. That's the number one thing. A lot of people got caught out in I think when in the sort of 2022 time when the interest rates really spiked. I think
Mm.
sort of the wars started kicking off around the world. There's going for a slightly lower loan to value, not necessarily maxing out the amount of loan or mortgage that you can get. I think that's
Yeah.
always sensible. I know sometimes affordability might be a factor there, but maybe
Mm.
go for a slightly smaller property. We
Yeah.
see so many times where people overstretch themselves, and then if
Mm.
there's a flex in that interest rate, all of a sudden that can
Yeah.
become an issue. So yeah, it's
Gotcha.
just about sensible investing, and that's what we're
Mm.
here to do. Here to guide, offer support.
Mm.
Talk through the risks that may be in front of us, and work to mitigate them as much as we can.
Yeah, right now it seems to me interest rates will continue to remain low. I'm
Yep.
expecting possible further reductions, hopefully in the next 12 months. So if you buy today, by the time, if you are buying off plan, but we do have completed options as well, interest rates could likely come down further, based on what we're seeing. But we'll have to see what also happens at the next budget meeting. There's going to be some shifts in policy as well. Oversupply risk, I can answer that one very easily. I love it when I get asked this question. There's currently a massive shortfall of houses in the UK, over 7 million. The stats 5 years ago, they said they need to build 350,000 homes a year, and they were only building circa sort of 100,000 a year. That's now, according to Savills and JLL, jumped to 720,000 a year, and they're still not building nearly anywhere near as much housing to meet the supply. So I cannot see that ever being a problem in these key cities or regions, unless for whatever reason, everybody decides to leave. Now, yes, you've got some people going over to Dubai and things like that, but it's still a densely populated island, and there's still this, it's a housing crisis, they call it in the news, right? Anyone can Google housing crisis UK. And again, it's just because the demand is continually outstripping supply. Do you think there's any oversupply risk in any of these areas or markets?
Yeah, it's an interesting one. That I think there's always a risk in certain areas, and that's why also quality is a really important factor when you're
Hmm,
looking at property. If you're buying quality in the right location, you're always going to beat the same location but less quality. So I
gotcha.
think that also is a protection against that risk there. Interestingly, sort of on the broader subject, like you were saying, the UK is seen as one of the most politically stable environments in the world, even though we
Hmm.
have Labour here. I won't go too much into politics because you shouldn't talk too much about that
I don't think
subject.
they're going
But
to be around much longer, let's be honest.
I
So,
yeah tend to agree. Tend
so
to agree.
yeah,
But that said, they haven't done lots to stimulate the economy. They seem to have done a
yeah,
lot to potentially push some of the good minds out of the country to places like you
mm,
mentioned out Dubai. However, that is a real opportunity for us as investors because when there's sort of bad news out there, that
mm,
who's reading that bad news? Not only us are reading that
oh,
bad news, but sellers are reading that bad news. So we can use that to our
mm,
advantage to use it as rationale for why we need to reduce their price to then make an offer. And we're seeing, and I think you agree, Dale. We're
yeah,
seeing sellers more than ever in the last 6 months being much
yeah,
more flexible on terms and pricing. However, that won't stay for a long time if interest rates are continuing to come down. So we've got this
that's
small
it.
window of opportunity that we can really make hay while the
Yeah.
sun shines.
So one of my favorite quotes, just so I get it right, is Warren Buffett, right? And he
Mm,
says, "When others are fearful, uh, be greedy, and be greedy when others are fearful, and fearful when others are greedy," right?
that's it. Yeah.
And that sort of sums it up. So that's the current situation, and we've secured
Mm,
some really, really great deals recently. But I do
yeah.
believe that's a potentially limited window of opportunity. So we'll move
Yeah.
on.
No,
Finance
that's it.
snapshots. I mean, we don't have any mortgage. We had a mortgage broker expert, Darren Crocker from International Property Finance Solutions. They've currently got a exclusive offer for international buyers where they can get in a good rate. I think believe fixed as well for like 5 years. So if you are looking for mortgage consultation, just put mortgage in the chat and we can put you in touch with them. What some investors don't realize, this is something I really capitalized on when my apartment went up. So bought for 200,000, 320,000 valuation 6 years later. I did what's called an equity release and refinanced at a lower interest rate. That allowed me to release capital and then reinvest. So some people here might have properties in London or wherever it might be. And what they don't know in the UK, Matt, is there's a process is slightly different in the UK. You can equity release and refinance. Do you want to maybe just, without giving financial advice, to sort of give us some guidance on how that works?
Yeah, there is lots of different options, and obviously we can introduce you to the broker should you want to explore further. But yeah, if you've got an asset which has got equity in it, whether it's unencumbered or it has significant equity over and above the current mortgage, you can do what's called an equity release, where you can pull some of that equity out
Hmm.
and then invest into another property to give you a cash flow. We've helped
Yeah,
lots of clients do that over the years, and it's a real way of utilizing the value in your bricks and mortar effectively to then get you another income stream.
that's it. So you can actually grow your portfolio by using your existing property. Now, you might have bought that property when all the war was going on and everything else. It's hopefully stabilizing in the near future. Nobody wants to see these things happening in the world. It's quite frankly terrible, but we are seeing some hopefully peace being made in the Middle East, and of course the Ukraine-Russia thing. Trump's working on it. Cross fingers, but it does create a bit of destabilization in the markets. However, the takeaway there is where do you invest? You've got gold, you've got crypto is fairly, um, these things can be quite risky. Bitcoin dropped massively just a few weeks ago. It's all depending on government regulations. So I think diverse portfolio is important. Um, are you seeing more interest from cash buyers, mortgage investors, or what's the current demand like? Are people leveraging or mainly buying with cash?
Yeah, like I said earlier, we're seeing more cash buys over the last few years just because of higher interest rates. However, that is starting to shift now as we start to see the interest rates come down. I'd always say cash will always get you a better deal with a seller. That's always going to get you that negotiation power. And I can actually see, I'm not going to name him, but I can see one of our clients that we managed to do that for recently.
Right.
But yeah, I'll leave that one there. But yeah, the question you talk about, are we seeing more
Mm.
leveraging? That's started to become more of a trend now because of
Yeah.
the interest rates are coming down, and we're going to see more of that as it continues, which is a really good sign for growth in the market because you've got more transactions happening, which there's
Mm.
cheaper borrowing rates there. That's really going to stimulate growth.
Great. So again, our services are fully comprehensive. We source the properties, prices are direct from the developers. Unless we do also offer, there's an asset management division, Steve Jacob, our CEO, Mike Bellini, Rick's Chartered Surveyor. So one question I get asked, what else do we offer, Matt, besides, because not everyone wants like new build off plan.
Yep.
Do you want to talk more about the other side of the business just quickly before we wrap things up?
Sure. Yep. So we, as Dale mentioned earlier, we are whole of market. So we don't just offer city centre new build or commuter belt new build and off plan. We do offer freehold opportunities, sort of houses, blocks of flats, HMOs, etc. So won't go into it too much detail now, but if that's something of interest to you, do let us
Yeah.
know. Can book a strategy call, and yeah, we can certainly discuss that with
Yeah.
you further.
Yeah, there's two different investments. You've got active and passive. Passive, you just want something fully managed. It's got a new build warranty. It's energy efficient because that's a big thing now as well, right? EPC rating. But if you want to really sort of look at this from a professional investment perspective, Matt and the team can source high yielding HMOs and other types of properties, fix and flip type deals, commercial and asset management as well. So, yeah, whole of market. So just to wrap things up, I think really that sums it up. We're focusing on yield right now, liquidity and diversification. We always say to investors, don't overextend, structure deals to survive any market phase. So back to stress testing, number two. Number three, work with advisors who understand finance, tax, and cross-border strategy is very important. Things like getting money transferred, currency exchange, setting up a limited company, or whether that's the right thing to actually do. Because in some cases, if you're just buying one unit, it's not. So 2025 year in my thought process is a good time to position, not sort of chase the last cycle, but look at new opportunities and where, you can potentially have a slightly upper hand because of the current market conditions. If you want to book in a free consultation, just scan the QR code, and that will also, you'll get the free 2025 Commuter Belt investment report. So if you just scan the QR code or just put free guide or free consultation in the chat. And then we'll move on to questions. If you want to just stop, we'll wrap things up and just take a few questions quickly in the chat. I'll stop sharing. Where's the chat? There we go, chat. Uh, everyone. So yeah, if anybody wants to drop any questions into the chat,
Got one
that'll be great.
here now that we also seen that was asked earlier. There are several projects here that I'm interested in. Can you send me some emails outlining the developments?
Yeah, we can definitely send some emails. So in our proposals, we'll attach the brochure, the financials, and the price lists. But we do believe it's first a good idea to have a Zoom call with me or Matt. You'll be speaking directly to a director, senior experienced directors of a company, and then we can discuss exactly what your strategy is. Again, you just need to book in a Zoom call with us. You can do that by booking in on the QR code, or I can actually I'll drop in the meeting link shortly into the chat as well.
Perfect. Thank
Just
you.
looking for the link.
Yeah, no worries. Um, got another one here. Um, are there any areas where development is so strong in the city centre that land is running out to build on? I'm thinking I need to invest in those cities now.
Definitely. I'm actually, whilst one needs to be cautious, I think Manchester's definitely one of those. There's just no
Yeah.
land. I've put in the chat there, book a meeting if anyone wants to book in into my calendar there. A suitable time, but Manchester definitely, running out of land and lots of development demand there. You've got some big guys like Salboy, Gary Neville, the footballer, has built a W there. He's broken records with his prices, and Salboy's actually got a new scheme coming. Is it Novamet? What was
Yes.
the prices on that again? Going to be coming in at like 900 plus per square foot.
Yeah. Record setting.
So yeah, it's branded stuff, but we have access to it. But yeah, it's there's a lack of land there, but also Liverpool. Liverpool's very interesting because it's next to the Merseyside. You've got the big Liverpool Water Visions that's gone through planning now. So that's a 5.5 billion pound investment. And you can either go north of the city now, south of the city, because the actual city centre, there's not really anything left for sale in terms of land, unless it's office to resi. Any other areas you think? I think Liverpool to me seems interesting because there's not much. You've got to be careful with Liverpool, of course, but there's not much land to be developed, and I think it's kind of on the maybe a little bit behind Manchester, but I do think Liverpool's another one where there's not much land left to develop on.
Yeah, totally. I agree. Liverpool, Manchester, they're the two
Yeah,
sort of leading regional, but you
yeah,
go to places closer to London, I think those areas also, are getting
mm,
built up now. And that's one of the reason why you've got property prices increasing because,
mm,
being the the planning process in the UK, if anyone on the webinar has ever gone through planning, will probably have a wry smile as I'm telling you this, but
mm,
it is a painfully slow process, which
mm.
is one of the factors of why there is a housing crisis because they're not putting through enough planning permission to build more homes. And that's
Okay,
one of the things that the government need to deliver on to enable and release the bottlenecks in delivery of houses. So that's another thing which every party says they're going to deliver, but then sort of fall short on every time they come
mm,
into power. But there we go. I've just noticed we've got another question here, Dal.
okay.
So how has improved transport infrastructure, for example, the Elizabeth line and HS2, influenced the capital growth and the rental yield in the commuter zones?
Sorry, just repeat the question. I'm just checking if the chat's working out because I'm just
Yeah,
trying
no
to.
problem. So
Yeah,
it's
go
how
on.
has improved transport infrastructure, for
Mm,
example, the Elizabeth line and the
yes.
HS2 corridors, influenced capital growth and rental yields in the commuter areas?
Yeah, definitely. I mean, like I said, I bought properties back in 2012 commuter belt. They went up 50, 60, 70% in value. Now, if you're on that Elizabeth line, which is a great line, by the way, I was there last time I went there. It's like quite spacious, and I think they had aircon finally on the underground. So,
Yes.
I don't probably know as much as you do, Matt, on how that's
Mm.
affected certain areas, but that particular Elizabeth, anytime there's an infrastructural development with new transportation, or big business or big companies moving into these areas, it's going to have a knock-on effect. So that Elizabeth line certainly has had a positive effect on that particular commuter belt areas, and it's opened access and easier commute to certain parts of London, which has, of course, affected property values.
Perfect. So there's another question here come in. So I'm happy to take this one down if you like. So it says, if you had 400k to invest,
Mm,
would you invest in Manchester commuter belt or would you invest in the London commuter belt in areas like St Albans, as you mentioned? Um, Really good question that, and it's a difficult one to sort of give you a catch-all answer because everybody has different circumstances. Both
mm,
are really compelling areas for investment. Um, I would say if you've got Manchester, it depends on how much, I guess, other capital you've got. If you've got 400k and that's your very first investment, then probably I would go to Manchester, most
Mm,
probably, because you're not going to invest all of your cash in one go. However, if you've already got a bit of a portfolio and maybe you've already got a Manchester sort of property in your portfolio, then I'd suggest the next best step would maybe to diversify and
mm,
look at a different area. So I know it's a bit of a politician's answer, but
mm.
I think it really depends on the individual, and that's why having a conversation with us is important.
Gotcha. Excellent. So I was actually just checking some stats. Homes around Elizabeth Line Station, excluding Prime Zone 1, where demand was already high, I've seen price rises of 80% from 2008 to 2023. So that's definitely had a very positive effect on, especially like the outer commuter zones. So Shenfield, Abbeywood, Heathrow, and Reading in particular. Just a bit of data on back on that question. Um, but yeah, I think with that HS2 now going to Birmingham, that's the kind of I'd be looking at that track where that's going. So,
Yeah,
you know,
totally.
so
And
that's great.
just something to add, guys, as well. Before we wrap up, we would love to meet you. If you want to come up, go and see these areas with us. We are open to that. We, run tours if you'd like to come and look at these projects with us. So please just let us know
Mm.
if you want to have a strategy call to start with, or you want to get out there and actually, expand some shoe leather and actually see the properties in person. We'd be more than happy to host you as well and get out and see them.
Excellent. So again, if you guys want to book in a meeting, I've put my link in the chat. We've been getting some chats in, but there has been a slight tech issue, so I do apologize. But do get in touch with us directly. We can speak one-to-one. Myself and Matt are happy to assist. We can also offer inspection visits. If you are coming from overseas, if you do decide to buy a property, Matt, I believe we doing an incentive at the moment for up until Christmas where we cover the cost of the flight. Is that correct?
That's right. Yep. That's
Yeah.
it.
And then we'll take you around. Matt's met a few of my clients recently from South Africa. Uh, Obviously, they wanted to come and explore, so he picked them up, showed them around Manchester. They've purchased one unit in Manchester, one in Liverpool, which is going through. So it really helps to get on the ground with the team, and then they'll pick you up, show you around, show you the show flats, so you can get an idea of the finish, and then look at the different areas and locations. So again, if you do want to arrange an inspection visit, feel free to get in touch. But I think we'll wrap it up, Matt. Thanks so much for your time. Really
Yeah. Thank
appreciate
you.
it. Enjoy the rest of your day. Thanks for those who have attended, and there will be a webinar replay which we'll send around if for anyone who has missed it. Feel free to share it with your friends. We do also offer generous referral fees if you've got anyone considering investing. Thank you very much for your time. Take care. All the best. Cheers, Matt.
Cheers.
Thanks. Take care. Bye.